Welcome. Godric here, your stock market mentor. Monday night stock market mentoring. How are you? Tonight, we're a little late, so we're going to do a few stocks and wrap it up. Appreciate you. I wanted to talk about something tonight. About the market, about the health of the market, and about if we have a correction, what position to take in the case of a correction. And I want to show you. I want to show you like a short position or a position that we can use if the market corrects, for example. Okay, welcome. Monday night stock market mentor, your Godric. I want to talk about a couple stocks today. Let's start with the Dow Jones. 34,337, up 54 points. So it's November 13th, 2023, Monday. And we just had Veterans Day over the weekend. So honor the veterans from World War One. People are defending our country right now. Army, Navy, Air Force, Marines. Most people take that for granted, 24/7 patrolling of our borders in the U.S. And our strong military prevents people from invading, people from attacking and getting what we have. If it wasn't for our military, especially the men, I have to say, because the majority of the military is the men, we could have a Ukraine situation, Ukraine, Russia. This could be like a Hamas-Israel situation right now in the U.S. But no, because we have those military men there patrolling our borders, keeping us safe. So hats off to Veterans Day. Okay, enough of that. Now back to stocks. So the Dow Jones being 34,003 is important because the all-time high is about 36,000 something. I think 36,006. So if the market can climb up to that all-time high, let's say 36.6, and break it, we could go into new highs. And that means a new bull market. That's never a guarantee as far as how long that will last. But if you're an investor, you're a trader, you'll see your stocks going up in a bull market typically. If you're in real estate, and the real estate market goes up, your properties are going up. That means more loans. That means more money, more cash flow. Same thing with the stock market. Your shares go up. You can sell your shares for profit. You can just hold your shares, and you see them go up in value. The stock market is one of the few avenues where over time you can get exponential growth, and that's why it's good. That's why I teach it. So welcome. Welcome. Appreciate you. Okay, so the first stock I want to talk about is Roku. Roku. I don't think I did Roku last week, so we can do it this week. Roku. Hello, April. Welcome, April Adams. Appreciate you. Give me some likes. Give me some shares. Get some people in here. Roku stock. I have it here. Here we go. 83.97. It was up today 266, and that's a nice move. It's not up all the time like that, but when it's up like that, you get that appreciation. Your shares go up. The investors are happy. Over time, if your stock goes up, then you're making money. You're getting a return on your investment. 20 days, 1 month, 3 months, 6 months. These are all time horizons. So like, when you're investing, you're buying these shares in the market. You're hoping they're going to go up, but you have to consider the time horizon. Let's say you want to give it 6 months, for example. Let's see what you can get in 6 months. If a stock's going to go up in 6 months, that could be indicated that it can continue. And then you go longer, 3 years, 5 years, 10 years. Ultimately, if you have a stock that can go up over 10 years, that's a good investment because it's showing you it's maintaining and it's showing you it's proven itself. It's passing the test of time. And when you're investing, you want to be, my advice, in a stock it's gonna pass a test of time. It's gonna perform over time, 3 years, 5 years, 10 years. So keep that in mind. A lot of these stocks, unfortunately, are like fly-by-nights, are not meant to last. That's why I recommend you guys stick to quality stocks like the S&P 500, for example, the top 500 companies, and as far as revenue, as far as profits, as far as the number of employees. Avoid penny stocks, avoid low price stocks. I always teach this. You don't want to gamble. You don't want a long shot. You want something that's more stable, and that's more sure, and that's more you're more secure about. In the stock market, there's risk. So why make it worse? Why add to the risk? If you want to gamble, I would say go to Vegas because in Vegas, it's just nice cocktail waitresses, serve you drinks, serve you free drinks at the casino. And if you want to invest, if you want to make intelligent financial decisions, I say make that in the stock market. Gambling is for fun. Investing is for real. It's for long term. It's for life. Okay. Hello, Ruth, Courtney Love, Gorgeous. Welcome, Gorgeous Gangsta. Appreciate you. Beetle Build, Jamal Williams. Appreciate you. Give me some likes. Jeff B. Welcome. I'm going to talk about some stocks today. One is Roku. So Roku has passed the test of time, and it has a 10-year chart, meaning that it's been trading for 10 years. And don't take it for granted, but if a stock has been on the market for 10 years, trading shares every day, they have performed. They have maintained over time, 10 years. What are they doing? Their company, for the most part, is providing a service or a product. And if they can make a profit, for example, then they'll show profits on their balance sheet. Investors will buy their shares, for example. At least investors want to get a return. So if that company shows a nice balance sheet, for example, then they're going to attract more investors. If they have a product, let's say Apple, they have iPhone, that's a product. Coca-Cola has Coke. Roku has the couple things. Roku has the streaming service, similar to Netflix, but not nearly as big. They have a product also, the remote control, the Roku remote control, which can basically TV control, but it attaches to the Roku the Roku box, which streams like all the apps like Hulu and Netflix and Amazon Prime. So that hardware is their main product. Kind of like the Fire Stick, but I think the Roku is better than the Fire Stick. And they have a lot of growth potential, I think, if you look at the balance sheet, if you look at where they were and where they are now. So it's an $83 stock, could go back up to 100. They had a previous price of as high as 457 back before the COVID. So they had a big correction, but They went all the way down to, I would say, like 38. So now they're climbing back up. Look at the chart. They're climbing back up. They're coming back. They're reviving, and they're showing some better numbers. At least it's somewhat better. And this could mean, what could this mean? This could mean, I'm not going to take you right now, Shako. Appreciate you, but another live if you follow me. Appreciate you. We'll talk. Um, we'll discuss stocks. I just want to do a quick presentation tonight, so please understand. Okay, so back on Roku, it's giving some numbers that indicate that investors are going to buy their shares. Shares go up, and you can make some money. This $83, $84 share price, could go to 100, could go to 200, could go back up to 400, break the new high, 500, and then you're talking about like exponential growth. And if you have options, for example, like call options, then you're talking about like making a lot of money. And that's why people do stocks and options, because you can then make a lot of money. It's one of the few avenues where you can get a great return. So I think Roku is good. Let me just quickly review the criteria. I like one as a market cap. You can see above 11.9. Let's say 12 billion. Write this down in your journal. Get your journals out, guys. 12 billion market cap. That's not high. That's not big. It's small company. I like to have a market cap of around 50 billion if I could, because that size determines that they're going to survive in a correction or in an economic downturn. So Roku doesn't quite have the market cap I like, but I mean 12 billion is better than 1 billion, and 1 billion is better than 100 million. 100 million is like a property in Bel Air. So don't buy a stock that has the value of property in Bel Air, for example. Welcome, Mr. Brunel. Grana Benny. Shana. Pete, welcome. Capfire, welcome. Doing Stock Market Mondays. Talking about Roku. Next criteria after market cap is volume. You can see 7.3 million volume here for today. That's just today. And volume is good because the more volume you have, the more indicates you have more shareholders, more investors, more traders. And that means that, one, your stock is liquid. You can buy and sell. It has a tight bid. Write this down. Tight bid and ask. Tight bid, ask. Because a lot of volume indicates that there's a lot of sellers and buyers. And for one thing, when you're buying and selling a stock, if the bid is wide, if the bid ask is wide, then you're going to be losing money going in and going out of the stock. Like for example, here it's showing the bid 83.92 by 84. So like that's 8 cents. So to buy the stock, you got to pay 84. Okay. But to sell a stock, you're going to get only 83.92. So you're losing 8 cents right there going in and going out. But that actually is a pretty tight bid. 8 cents, not bad. So there's not enough buyers or the buyers indicate that they're going to pay 83.92. So you can always sell it for that price. That's the market price. And then the lowest seller wants to sell for 84. So when you're going to buy the shares, you got to pay 84. Anyways, the point being, a tight bid ask is healthy. It's good, and it brings more buyers, and you have more volume. And the second reason why the volume is good is because when the stock dips, and your stock will dip, I'll just guarantee you, all stocks are going to dip, whether it's a correction, whether it's someone just sells a bunch of shares. And when those shares dip, you'll have more buyers willing to buy that price lower. They think they're saving money. They think they're getting a good deal, so they're going to buy that. But let's say it dips from 80 to 70. Well, investors that like Roku, let's say like myself, we buy those shares because it's like a bargain, or even if it's 60, for example. So when we buy those shares lower, it supports that stock. It supports the price, and it's going to climb the stock back up to where it was if you have the buyers. So that's the difference with volume, with a stock with volume and a stock with no volume. If you have a stock with no volume, indicates not enough buyers and sellers. And when that stock dips, there's no one to buy it, and you could be stuck in that stock for months, for years. So the good thing about big stocks like Roku, at least not so big, but at least has good volume, is that you're going to have the support of other traders that are going to buy those shares when it dips, and that's going to save your ass. So volume, check. Market cap, no. Market cap gets an X. The next thing I want to show is the 10-year chart. We talked about that 10-year chart. I'm going to give it a check because the 10-year chart on Roku, well, it's been trading for 10 years, number one. And two, it's higher now than it was 10 years ago. So it's technically gone up over time. They have a big roller coaster, and sometimes you got to be willing to accept that big roller coaster ride, And that's why I said the market's not for everybody. If you buy a stock, you're going to go on a roller coaster ride. It has something to go up and down. It could be going up and down every day, or every 6 months, every year. Your shares may go up in value and then come back down. And so people can't handle that. One thing about that is you can always write cover calls, which is what I teach. When you write cover calls, you're getting paid monthly. You're getting paid money monthly for the cover calls. You're basically renting your shares out to the public. As a apartment owner, owns the apartments and rents out the rooms in the apartment for a monthly fee, a stock investor can own the shares, let's say blocks of 100 shares, and write the cover calls on those shares monthly and collect a monthly fee for those shares. I'm going to show you the Roku cover call tonight, and we're also going to talk about gold. Peter, welcome. Chris Dunlap, welcome. Alejandro Flores, Sima Ba, welcome. I want to welcome you guys to my Stock Market Mondays. This is Godric here talking about, in this case, Roku. Send me some likes. Do a few shares. Hit the arrow at the bottom right. Share with your friends. I want to get some people in here tonight. The cover call is probably the best trade in the stock market, at least arguably the best trade, because what you're doing, effectively, you're collecting a month. In this case, I'm teaching you a monthly fee or a monthly income on those shares you own. And like for Roku, I think it's something like 5%, 4% a month. We'll actually do that now. So it does have the 10-year chart. And the next one is the PE. Let me do this real quick. PE is profits. If your stock shows a PE that's positive, that means it's making profits. If your stock shows a PE that's negative or a dash, it's losing money, no profits. Roku is not showing it's showing a loss right now, so that's X there. And that's the thing, I can give you a great stock, but let's say like Apple. But the return is less. The cover call pays less. The risk reward is going to be less on something like Apple because it's more stable. On Roku, it has a couple, a couple X's. They're spending more money, so they're not making as much profit. So the PE is it's like minus. I don't know. You can check it out if I have it here. I don't show it here, but. I think they're losing like $4 a share. I have my Schwab up. TD moved to Schwab. And we can look at research. You can pull up your stocks online and they can show you the PE. Every broker's different. So Roku doesn't have a PE, so that gets an X. And the last criteria is a cover call, CC. CC per covered call. And they do have a covered call. We're going to give it an X. We're going to give it a check mark. And covered calls, I like you to be able to make like between 3 and 5% return per month. And that's what I'm going to show you right now. Impose the option chain for Roku. You can get, I want to say 5% per month. There you go. Okay, so here's the option chain, guys. So if you can buy 100 shares of Roku, you can do the cover call. 100 shares of Roku here at 83, let's say 84 will be $8,400 investment, okay? So that's a decent size investment. You know, if you don't have that, start saving. I would say sell all the shit in your garage. Get that money, okay? But look at this. If you were to write the 85 cover call, which is you're agreeing to sell it for $1 more for next month. This is the option chain for next month, December. So in November you write December. In December you write January. In January you write February. We always go out 1 month. That's how I teach. And here, look at the strike. Strikes are in the middle. Calls are on the left side. Puts are on the right side. I'm not going to do puts today, just calls. So we buy 100 shares for $8,400. We write, in this case, we write the 85 call. And this is paying $460 by $470. And you see that? That's a bid ask. And that's a tight bid ask. Because there's enough volume. If there wasn't the volume, you wouldn't have that tight bid ask. So what's happening here? So we take 100 shares, write the cover call on the strike 85 right here behind me for December. We're gonna get $460, which is $4.60 per share, pre-share Roku, or 100 shares gonna pay you $460. Okay, that's for the Roku cover call for 1 month. Actually, it's 5 weeks because it's a little early. Usually, it's a third Friday is when the option expiration. So it's technically a 5-week trade, which is fine because, you know, let's just do the math on that. If you did a cover call every 5 weeks, there's 52 weeks in a year. Divided by 5 is 10.4. So you can write 10 cover calls. So here's what I'm saying. Here's the math. You ready? Your investment, $8,400, buy 100 shares of Roku. You're going to get $460 per month. Now, this is just, it can change, right? But it's going to be around this amount. And not per month, but every 5 weeks. And according to math, you can do it 10 times a year. And that means that it's going to give you $4,600 per year because you can do 10 cover calls on a 5-week rhythm. Or a monthly. A monthly's better. Monthly's easy. But in this case, $4,600, which is like, I mean, it's more than 50% return. Here, let's do the math on that. For a 5-week trade, you do 4.6, which is 460 divided by the share price. Let's say $84. Make it easy. 5.47% return. So for the month, we're getting 5.47% return for the cover call, which is great return. Most stocks will not pay this amount. So don't just grab a stock and do a cover call. You want to look at the return. The nice criteria I like is 3 to 5% for a month. This is a little more. Why? Because Roku's hot. Because investors favor the stock. The VIX is going to go back. I'll tell you, they're going to go back up to 100, 200, 300. I'll tell you that right now. And welcome, guys. Welcome, Doggy Dog, Donnie. Welcome, Zionville. Appreciate you. Give me some likes. Stock Market Mondays happening here. Talking about Roku. Talking about the cover call. We can make 5.47% basically per month or per 5 weeks. Again, back here, the option chain, just pull the option chain. You can do it with Google, but if you have an account, a stock market account, they have the option chain there for you. We agree to buy the shares here, 84. We write the 85 call for, it pays here on the bid on the left side, $460 per share. That's $460 income. And $460 could pay your car note. that can pay your light bill and your gas bill. And that's what I'm teaching. I'm teaching to what? Get stocks, get investments, right? Cover costs, for example. Pay your bills from your account, pay your bills from your stock account, and you retire the stock market. That's what I'm teaching. Now, there's some downsides. For example, the roller coaster. This $84 share price is not going to be $84 all the time. Like, it went up $2 today to 66. Gotta be willing to ride this roller coaster ride. The idea is to hold on to your shares as much as possible and keep writing cover calls. But seeing that your shares are going to go down and up, that's stressful for some people. Some people, they get stressed, they get anxious. Some people pull their hair out. You got to be able to tolerate the whims and the roller coaster of the stock market. So that's one thing. So it's not. I make it look easy. It's not so easy. There's issues you're gonna have, but what is November 13th, 2023? We'll talk in a year. Just did you write 10 cover calls on Roku? If you don't know really what that means, that's okay. You can learn. Call your broker. Schwab. I'm assuming. Has all the great customer service that TD Ameritrade has. They're switching over to Schwab, and they will walk you through the trade. Message me. I will walk you through the trade. I teach. That's what I do. This is a good investment for, I say, moderate risk. There's always going to be risk in any business. Stock market's no exception. And $8,400 investment pays $460 about every month or about every 5 weeks. $4,600 per year. But I'm just going to lower that number because I want it to be doable. You can mess up and still do a good job in the stock market on these cover calls. If it's 5.47% for 1 month or for 5 weeks, let's just say, I'm not going to say 54% because even though we can do 10 cover calls, I'm just going to say like 40% return. Probably get I can get 40% return on paper. Now, what's going to happen in here? We don't know. Roku could go down. I don't think it's going down. I'm telling you, look at the chart. It's heading up. So this is why it's better. So if you're getting a 40% return on your investments, 100K is going to give what, 40K in a year. $1 million is going to give 400K. 1 million equals 400K. And that's really, you'd be on your way. You can retire in the stock market. And if I wanted to pick a 9-to-5 job or doing cover calls, investments, stock market, well, you'll be your own boss. Thank you for the likes. Appreciate you. You can ask a question here if you have any questions. Bernie, appreciate you. Donnie. Oh, sorry, Donnie. So cover calls, arguably the best trade in the stock market. I teach that on Monday nights. Follow me, send me a message. And another trade I want to talk about, I'm going to move on to gold. Okay, so there's a lot of talk about Brexit, and the market crashing, and the economy changing, and people are going to get off the dollar and go to other currencies. So this could cause a correction. Not saying that's going to happen, but one trade, and this is like I say risk capital only. It's not like a Roku trade because this is a trade that you're going to do if you're somewhat savvy, or at least you're willing to take a risk. If you want to bet on the market going down, one way to do it is to buy gold, because gold tends to perform reverse of the market. If there's a crash, for example, because the dollar is weak, because there's problems in the economy, gold will go up because investors rush to gold as a steady currency. So here, let me show you gold. Okay, this is the gold ETF, GLD. So symbol. Oh, the Roku symbol, ROKU. Write that down in your journals. ROKU. Check it out. See what I mean? Okay. Gold is GLD, and this one here is 180.54, 51 actually. The price here is somewhat reflective of the gold price times 10, because I think the gold price is about 1,800 right now, an ounce. And this here is 180, so I'm going to say that indicative of the gold price per ounce divided by 10. So today GLD was up $1. Now I want to show you the cover call on this. I'm not saying that it's a great trade, but you can do it. Doesn't pay as much as Roku, so check it out. Watch this. That's Roku. Here's gold. Okay, so you know how we're getting 5.47% on Roku, and it's $460 a month for 100 shares on the cover call. If you look at gold, it only pays, if you buy it here for 180. I always write the higher strike price. So in this case, the 181 or the 182. Let's go to 182 because we want to give some share growth. So you can, in this case, you're going to spend 18 grand because 100 shares at a 180 stock is $18,000. So you can put 18 grand, 18K, buy 100 shares of GLD, and you can write the cover call here showing, I'm going to say the 182. This is December. In November, you write December. In December, you write January, etc. It pays, is showing a bid of 241 and an ask of 245. Tight bid ask, even tighter than Roku. And that's where volume comes in. Volume is good. Write this down, 241 by 245. Now, notice the share price is higher than Roku, and the return is less because Roku we were getting 460. This is like half of that, and you're paying more than twice. So let me show you the math on that. So we do 241 divided by your share price, 180.51, equals a return of 1.33%. It's almost not worth doing it, but you could do it. 1.335. Let's just say 1.34%. If you wrote the 288, you get a little more. Let me do that. I'm sorry. If you wrote the 181 strike, you get 288. So 288 divided by 180.51 is, now you're getting 1.59. Let's say 1.6%. Let's do that one. 1.6% return. A strike 181 for December. So you agree to sell the shares at 181. That's the difference. If you go 182, then you're allowing for more share growth. You can get that money if it goes up, but you get less money on the premium. It's like one bird in the hand is worth two in the bush, right? It's because it's better to have something that's more certain than you go for something else that may be better, but you may not get nothing. So in this case, that's the analogy I put with the cover calls. With the strikes, as you go higher the strikes, you're agreeing to sell the stock for more. But seeing that it may never get to that price, it might, but it may not. You're going to get paid less on the premium. So I always write my cover calls higher than the strike price. I like to get to a sweet spot. In this case, 1.6% return. Not great, but it pays 160. No, it pays 100 and how much? It pays $288 a month, or per 5 weeks. That'll be $2,800 per year, multiplied by 10. On the Roku Roku investment, you're paying $8,400, and for your investment, you're getting $460 a month times 10, $4,600 per year. On the gold, you're paying $18,000. You're getting $288 a month, or $2,800 a year. So like that's your investment. You buy the shares, write the cover call. That's your business. That's your business strategy. That's your investment. That's your income. The difference here is that gold is much more stable than Roku. Gold being, an equity, being a tangible product, a tangible, it's like a money system. It's a form of trade. It's not going to change that much month to month. Whereas Roku, it's going to go on a roller coaster today right now. So it's more risk on the Roku, less money, more stability on the gold, less money return on the gold. Okay, but that wasn't the trade I wanted to show you. I just wanted to show you the difference between the Roku cover call and the gold cover call, which you could do. But here's the thing: if we crash, if the market crashes because of this Brexit, because of this economic turmoil, gold will shoot up. It can go 19,000, 20,000, 21,000, 25,000. And if people start selling the dollar, they're going to move their money to gold. This is just my experience. They do that. And an investment in gold can get a nice return. It's like a hedge. It's a protection against a stock market crash. And that's what I'm going to show you. So, in this trade, I want to show you someone can do. Instead of writing a cover call on gold, you can buy the calls. And what that means is you're buying options. You're trading options. For every stock or ETF, there's like 1,000 options, and they go out every month, and they even go out like 3 years. And you want to pick the option that suits you, right? So my definition of an option is how you control a stock with less money but more risk reward. That's it, right? So in this case, when you buy one call option, you're controlling 100 shares of the stock. So you're putting less money but more risk reward. In this case, if you just did 1 month, which I don't recommend doing 1 month, but this is December, you're going to pay $288 per share, or $288 for the gold option. And you're controlling technically 100 shares. So you're going to control basically $18,000 investment, because you're going to get one call, which equates to 100 shares of, in this case, not the stock, but the ETF. So like for Roku, like you can pay, you can pay the $460, buy the call instead of selling the call. You can control $8,400 of shares. And with the gold, you're going to pay only $288 to buy one call. You're going to control $18,000 technically of the ETF, a gold ETF. Now, I'll tell you right now, gold's generally not going to move like Roku moves. So that's why it's cheaper. Like the Roku option is much, much more expensive. And that's why I say, instead of buying it, sell it, because you're getting consistent income. You can pay your bills, you can retire into the market. But like I said, you can go both ways. You can buy or sell. And there's one trade I want to show you before we wrap up on gold. And we're going to go out 3 months on the call. So write this down in your journal, okay? This here is the January option chain for gold. And if you wanted to, for example, buy a call out of the money, which is risky, but it could give you a nice return. And this is like the hedge. This is the hedge trade I want to show you. Okay, so you go out 3 months. So it's November, December, January, 2 months, right? And in this case, we're going to buy the 105. You see how they're circled? So write this down. GLD. I'm sorry, 205. 205 strike January. Okay. And it says here, 24 by 25. Now, This is kind of like fluff. It's high risk, but it's high reward. So it's both. So what that means is you're going to pay 24 cents or $24 for 100, which is one contract. So it's going to be $24. I'm sorry, $25 because you have to pay for the ask. When you sell it, you get to bid 24. When you buy it, you pay for the ask. So it's going to be $25 per contract, and you're buying this call option, the 205 for January. And this can have you can like double your money, triple your money. And this is an option trade. It's high risk. I say risk capital only. Don't put your rent in here. Don't put your kids' college fund in this. Why? Because probably, there's a good chance the market won't crash. There's not going to be another war. Not going to be World War III. All that fear and I say propaganda about everything going to hell. It probably won't go to hell. And the gold price probably won't go up. So this option you have is going to go to what? To zero. Fat goose egg, right? But if we do have a correction, I guarantee you, gold would be going up. Gold will be shooting up. This option, this price here, 180 can go to 192,000, 2,100, and this option can go to $2. It can go times 10. And what platform? What investment can you get 10 times your investment? You can even if you did get 10 times your investment, you can afford to lose a few times, before it pays off. And that's what these call options do basically. That you're looking for oftentimes you're looking for a long shot. Or you're looking for the stock to move up, and you get paid. And that doesn't happen that often. It really doesn't. A lot of times the stock's the same price this month and next month. And when you bought the call, you lost the money. But when you write the call or when you sell the call, you automatically get the money because you get paid up front. So write this down in your journal. Write cover calls. Okay? Get that money. Get that monthly money. Buy calls only high risk, man. Only if you want to get a long shot, or if you're somehow certain that your stock's going to go up, because most of these options expire worthless. I'll tell you that right now. So you're playing with fire, my friend. Okay, so here, this is gold. Doing this right. Here's another trade. It's a more advanced trade. I don't want to get into it, but you buy 72. I have a client that put $1,800. He's buying 72 calls on the 205 January for gold. He's you hear on the news, oh, we can crash, oh, the government's going to shut down. For the most part, it doesn't really happen, honestly. But this trade is designed that the market corrects. If we have economic turmoil, the gold price will shoot up. You got 72 calls times 25 cents at $1,800. That's why I did that for him. There's another trade here. You buy the 205 January for $1,800. Then you sell the 215. You get here 9 cents by 11 cents. You get 9 cents times 72. You get back $640. So instead of having to pay $1,800 up, which is a risky investment, but also a great investment if the stock goes up, you're gonna buy that 205 call, sell the 215, get back a good amount of money, and you'll still have good play in the option because you're still long. You're long on the 205, you're short on the 215, so you're still technically long. And anyways, take a snapshot. You heard it here first from Godric. If we do have a crash, a lot of these investor traders have hedges. They have gold, they have call options, they have puts. Puts are when the stock goes down, you make money. In this case, we're using calls. We think gold will go up in the crash. So Like, and here's the thing: if you're managing, $100 million, you're like Goldman Sachs, and you're a trader that your job is to manage money, and you're managing a big account. You don't have the luxury to like lose money. So when you, because you get fired, your job's over, right? So what they do is they'll buy these stuff. They'll buy Roku, they'll buy Apple, they'll buy Tesla. They'll buy all these stocks that are doing great. They'll write the cover calls. Some of the stocks are getting dividends, so they're already making the money. But what they'll do, they'll put a small percentage of the money, let's say 5% or even 10% on a hedge. Like, for example, to buy gold, right? And the theory is that if the market crashes, these gold hedges or these other puts uh, um, positions, hedge positions, will go up vastly. So you're spending a lot of money. I'm sorry, you're spending a small amount of money on a long shot, in case the market turns the wrong way. In this case, and that long shot will save your whole account because instead of like losing like 30% in a correction, that long shot that's only 5% investment of your whole account. Since it's leverage, we leverage with options. With options, we leverage, right? That can like save you from, instead of losing 30% on a correction, you might only lose like 15% on a correction. And that's all the difference. Like, that is like bread and butter for an investor. Like, to be able to make money not only when it goes up, but when it goes down, right? So in that sense, you're lessening the chances of losing. If you have a terrible, if you're investing, whether personal or or for other people, and you have a terrible return, like let's say it's 50%, it's very hard to get that money back because that's at that point you lose 50%, let's say 100K down to 50K. To get that money back, you have to get 100% return to get the money back. So people buy hedges. People put hedges in place to lessen their chances of losing. And even if the money's wasted, even if gold doesn't go up, the market's fine. Probably gonna get Trump for the next president. The market will probably survive. Stock market will probably survive. All these hedges are just going to be worthless. But it's better to spend 5% in your account or a small percent in your account, and kiss that goodbye, than to not buy a hedge, to go long, to buy all these other stocks you think's going to go up, because you'll get a better return if you don't waste your money on hedges. But that moment that the market crashes, and it'll happen one day, it's going to make all the difference, because instead of losing a huge amount, you're going to lessen because you're getting money on that hedge. You're going to lessen your chances of losing, to make all the difference. And I recommend it also because it's instead of doing a roller coaster, it's more of a steady stream. That's why. So that's my take on that. Appreciate you guys. I will be back Monday. I will be back next week. We talked about Roku today. Talked about the cover call. Talked about gold. Talked about the gold cover call. Talked about economic collapse will shoot the price of gold upwards. And in this case, you might want to have these calls. Risk capital only. Save money. Sell all the shit in your garage. Put in the stock market. Do logical, intelligent investments. Have a criteria. Have standards. I have 5 standards here. If you're recording, I can back up the tape. And pay your bills and retire into the stock market. And I'll see you at the top, my friend. Thank you. Good night.